Saul, welcome to the deep dive. Our mission today, it's pretty focused, but honestly, the outcome is huge. Financial freedom, really, through getting smarter about the stock market.
We've sifted through a whole stack of sources, mostly building on the wisdom of investing greats. And the big signal isn't about chasing moonshots. It's actually about mastering the art of not losing.
hmm
So this deep dive, it's basically a shortcut into Warren Buffett's thinking. We're boiling it down to the 12 most common investing mistakes he often points out.
Yeah, think of it as your defensive playbook.
Exactly. If you can just sidestep these analytical traps, you're already way ahead of the game, right?
And absolutely, that focus on defense, it's so crucial. Investing success, it often boils down to steady compounding and just avoiding those massive errors. So for you, the listener, getting this map of the common pitfalls now, well, it helps you avoid stumbling into them later. We want to show you why these mistakes wreck capital.
So you can build a strategy that's disciplined, focused on quality.
Precisely. Focused purely on quality. Okay, let's unpack this. Starting with that first category. Those fundamental behavioral and price traps, the classic self-inflicted wounds.
Yeah, exactly. These aren't about bad math. They're about, well, flawed human psychology. And the first big one, it comes up everywhere. Trying constantly to time the market. People just sit there frozen, waiting for the perfect jip.
Or they panic and sell when the news looks grim.
Right. They want to be out for the downs and jump in just before the upswing.
And the data on this is just, it's brutal. That's why it's such a foundational error. The sources consistently show that most of the market's big gains happen in just a tiny handful of days, over like decades.
Just a few days.
Yeah. So if you're trying to time it, maybe you sit out, you miss just the 10 best days over 20 years,
Wow.
you could wipe out nearly all your potential returns. So what feels like being careful, waiting for things to settle, it's actually almost a guaranteed way to underperform. It's driven by this impatience, this belief you can predict the unpredictable. And that impulse, the urge to time things perfectly, it leads straight into the second big mistake, getting emotionally stuck on your purchase price. Ah, the anchoring bias.
Yeah. Say you bought a stock at $100. Then it drops hard, maybe to $40, and now you refuse to sell. Why? Because selling means locking in that $60 loss.
It's completely irrational, isn't it? It's sunk cost fallacy. It's ego. The market doesn't care what you paid.
Right.
And investors face a choice here. This is where it gets nuanced because someone might ask, hang on, isn't averaging down sometimes a smart value move?
That's the key question, isn't it?
Yeah.
How do you tell the difference between smart value investing and just stubbornness,
Yeah.
being unwilling to admit you were wrong?
It really comes down to your thesis about the business. Is the company still fundamentally strong? Do its advantages, its cash flow, its quality, are those intact? If the price dropped because of, say, temporary market fear, but the business itself is fine, then yeah, buying more might be rational. But if you're holding on just because you can't stand admitting the original idea was flawed or the business has actually deteriorated.
And you're just throwing good money after bad, basically.
Exactly. You're sacrificing future gains because you're emotionally tied to the past. Buffett's take is simple. Hold or sell based on today's value and future prospects, period. What you paid. Irrelevant. Okay, so ego keeps us anchored to the past. The next category, though, it shifts. It's not just emotion. It's misplaced optimism. Faulty math, really, that destroys capital. Here's where it gets really interesting. We're moving from emotional flaws to analytical errors and mismanaging risk.
Right. And the third major error is making wildly optimistic growth projections. This happens a lot, especially when there's excitement around new tech or a hot sector.
You mean like a company grows 40% for 2 years, and suddenly everyone assumes it'll keep doing 30% or 40% for the next 10 years?
Precisely. Analysts, retail investors, they get caught up in the story.
But wait, isn't the goal to find high-growth companies? Where's the mistake?
The mistake is ignoring reversion to the mean. It's a fundamental concept. Look, extraordinary performance, especially super high growth, it just can't last forever. It's unsustainable.
Competition comes in.
Competition heats up, markets mature, things inevitably slow down. So if you bake those unrealistic long-term exponential growth rates into your valuation models,
You inflate the intrinsic value number way too high.
dramatically,
Yeah.
which means you're almost certainly overpaying for the stock. And when reality bites, when growth inevitably slows, the stock will underperform your rosy expectations.
Which is why Buffett always talks about that margin of safety.
Exactly. Value it conservatively. So
Uh-huh.
even if growth slows more than you thought, you still haven't fundamentally overpaid.
Okay, so take that overly optimistic projection, and then add the next mistake on top of it. Now you've got a real recipe for disaster. I'm talking about using too much leverage. Borrowing money to invest. This one is highlighted as maybe the most dangerous because it takes away the one thing you absolutely need for long-term success.
Which is?
Time, staying power, the ability to wait out the storms, leverage, usually margin debt to buy more stocks or sometimes high-risk options. It strips that away.
Walk us through how it does that. Why does leverage make even a small mistake potentially catastrophic?
It's the margin call risk, primarily. If the market dips or maybe your optimistic forecast doesn't pan out and the stock falls,
The broker calls.
the broker calls demanding more cash right now. To cover those losses, if you don't have it, you're forced to sell.
At the worst possible time, usually.
Absolutely. Locking in permanent losses, and now you're out of the game. You can't participate when things eventually recover. Buffett sees leverage as like the ultimate test of temperament. It turns temporary bumps into permanent losses.
You trade patience for speed and often lose both.
You got it. It's the total opposite of the patient, long-term approach you need for real financial freedom.
So if we connect this to the bigger picture, all these pitfalls, the timing, the emotions, the leverage, the sources seem to say the best defense is really a proactive shift, right?
Yes, exactly. The prescription isn't just don't do these bad things. It's more like commit fully to doing the right things.
Okay. And the core advice that comes through again and again is focus. Focus relentlessly on knowable, high-quality businesses. Let's break that down. High quality. What does that mean in this context?
Well, the sources point to fundamentals, things like a durable competitive advantage,
Yeah.
Buffett's moat, something protecting his profits,
Right.
high sustainable returns on equity, strong, reliable free cash flow. You're basically looking for a business that can handle downturns without constantly needing more outside money just to keep the lights on.
Okay, so quality is the financial strength, the resilience.
So,
But you also said knowable. That seems just as critical, especially after talking about those projection errors.
absolutely critical. Knowable means staying strictly within your circle of competence. If you don't really understand how a company makes money, what its actual risks are, the industry dynamics, then you're not investing. You're speculating.
Like Buffett avoiding early tech stocks.
Exactly. It wasn't because he was anti-tech, it was discipline. He admitted he couldn't reliably predict their future profits or how the competitive landscape would shake out 10, 20 years down the road.
So the lesson for us is,
If you can't explain the business simply, clearly, maybe like you're explaining it to a smart teenager, you probably shouldn't own the stock.
that makes sense. And that focus on deep understanding, it seems to lead right into the last couple of related points or mistakes to avoid, rather.
Things Buffett really hammers on.
Yeah.
Avoiding the herd mentality and also avoiding over-diversification. Two sides of a similar coin, really.
Okay, let's take the herd first. Why is just following the crowd so bad, even if the crowd seems right for a while?
Because following the crowd means you've stopped thinking for yourself. You're outsourcing your homework, your judgment. Real investing needs independent, often skeptical thought. When everyone's piling into a stock or a sector, usually driven by FOMO, fear of missing out,
You're pretty much guaranteed to be paying a premium price.
by definition, the sources show the really great returns often come when you're willing to look different, to be contrarian when justified. Once an idea is universally loved, the easy money is likely gone. And that connects perfectly to the other trap. Over-diversification. Or, as some call it, diversification. Yes, diversification. It sounds funny, but it's a serious strategic mistake. Think about it. If you've done the hard work and found, say, 5 truly high-quality businesses you deeply understand.
Businesses within that knowable circle.
Exactly. Why would you then dilute your capital, dilute your focus, by adding another 25 companies you've barely researched?
It suggests you don't really have that much conviction in your best ideas.
Precisely. Owning too many things means you can't possibly keep up with the deep research needed on all of them. You end up watering down your winners with mediocre stuff, and you might as well just own an index fund. But without the low fees.
Focus is key.
Focus lets you leverage that knowable advantage.
So what does this all mean? Wrapping this up, our deep dive into these common mistakes. It really seems financial freedom through investing isn't about complexity or daring moves. It's defense. It's discipline.
The core path seems to be rigorously avoid those psychological traps, the timing, the price anchoring, the leverage fueled by greed, and just keep a laser focus on businesses you can understand that have real durable quality. That sums it up well. And it leaves us with a final thought, maybe a challenge for you, the learner, to think about.
Yeah.
If the goal is financial freedom through these high-quality, knowable businesses, how do we define and, more importantly, maintain that knowable edge today?
In the modern era.
Right. When technology changes so fast, it seems like it's constantly shrinking everyone's circle of competence. Industries get disrupted quicker than ever. So how do you ensure your knowledge stays deep enough to really invest with confidence and not just speculate on what feels unknowable?
That's a tough question.
It is. But grappling with that ongoing challenge, that's probably the real key to sustaining success over the long haul.